Good morning. These are the things that matter most before Wall Street opens. Futures are trying to stabilize after a bruising big tech session. The AI trade now needs spending proof. New global tariffs put import margins back in focus. And rates remain a filter because oil and labor data keep inflation risk alive. The central market question is simple. Can Wall Street broaden beyond a few mega-cap stories today? Or does every rally still need proof from earnings quality, margins, and cash flow? Start with the AI capex hangover. Yahoo Finance reported that the Magnificent Seven lost nearly $800 billion in market value in one session as AI spending fears gripped Wall Street. Google beat expectations, but the stock fell as capital spending growth overshadowed the cloud strength. Tesla also sank after a profit miss and a large capex outlook. This does not mean AI is over. It means the market is separating AI revenue proof from AI spending ambition. The cleaner side is infrastructure that can show orders, backlog, and margin support. NVIDIA, Intel, and Supermicro stay important confirmation names. Pressure sits with companies where spending rises faster than visible returns, especially Alphabet, Tesla, and stretched software or cloud suppliers. In plain English, the takeaway for private investors is this. A theme can be huge and still fail the morning test if the market cannot see when spending turns into earnings. Second, tariffs have moved from background noise to an import margin test. Yahoo Finance reported that the next phase of global tariffs affects almost all U.S. imports, with rates around 10 to 12.5% for much of the world. For Wall Street, the issue is not politics. The issue is which companies can protect margins if landed costs rise before pricing power catches up. Potential beneficiaries are companies with domestic revenue, local supply chains, and strong pricing power. Pressure sits with import-heavy retailers, hardware companies, and manufacturers that face cost pressure before they can reprice. For private investors, the useful filter is margin transmission. Watch whether companies explain tariff exposure clearly, or whether guidance becomes vague exactly where costs are rising. Third, the rates and labor filter is still active. Yahoo Finance reported that U.S. weekly jobless claims fell to the lowest level since 1969, while recent oil pressure has revived inflation worries and lifted mortgage rate concern. A strong labor tape can support demand, but it can also make rate relief harder if inflation pressure stays visible. The stronger side is banks with quality credit books, insurers, and companies with durable cash flow. Pressure sits with home builders, real estate investment trusts, long-duration growth, and rate-sensitive consumer finance. For private investors, the takeaway is not to treat strong data as automatically bullish. The market has to decide whether strong labor means resilient earnings or fewer reasons for yields to fall. The underappreciated story is Verizon. Reuters reported through Yahoo Finance that Verizon lifted its annual forecasts as new mobile plans helped subscriber gains, and MarketWatch said the stock rose because the company is no longer being treated as a promotional hunting ground. That is quieter than AI or tariffs, but it matters because it shows the kind of earnings quality this market may reward. Customers, discipline, and less need to protect volume through discounts. The cleaner side is Verizon, quality telecom cash flow, and companies that can grow subscribers without destroying margins. Pressure sits with promotion-heavy competitors, low-quality consumer cyclicals, and any company that needs discounts to protect volume. For private investors, this is a breadth check. If defensive cash flow stories can work while AI remains volatile, the market is broader than yesterday's mega-cap drawdown suggests. Here is the stock-led watch list. Alphabet, Tesla, and Intel. Does the AI tape reward proof and punish spending, or does yesterday's sell-off simply bounce? Walmart, Target, and Dollar General. Do tariff and consumer cost worries show up in import-heavy retail, or does pricing power cushion the hit? JP Morgan, DR Horton, and TLT. Do strong labor and inflation fears support financials, pressure housing, and keep bonds under review? Verizon, AT&T, and T-Mobile. Does subscriber quality beat promotion pressure across telecom, or is Verizon a one-company story? Market bias, selective, and proof-driven. Futures are steadier, but the bar is higher after the mega-cap reset. The cleaner setup is not the loudest headline. It is the company that can connect revenue, margins, and cash flow. The mistake to avoid is treating every rebound as confirmation. Today, confirmation means breadth, AI proof, tariff margin discipline, rate-sensitive groups behaving logically, and at least one non-tech quality story holding up. That is the U.S. Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice. It is not a recommendation to buy, sell, or hold any security, and it does not include price targets, stop losses, position sizing, or personal financial advice.